So yeah, what we're going to talk about today here is a little bit about Fibonacci, and we're going to talk about some beginning stuff, which maybe some of you don't know, and then also some more advanced stuff. And that way, whether you're new to it or not, there's something here for you today. And you can put your wallets away. I'm not selling anything today, by the way. I am giving away a free trading course, which every one of you will get who's here. It's a 5-day video correspondence course. Each day you'll get a free video, and at the end of each video there's a interactive quiz actually right in the video to make sure you picked up the lessons. And then on day 4 of the 5-day video course, you'll get my favorite trading setup I call the rubber band trade. And you get that with all the rules and the filters and everything, so all for free. So hang around till the end and I'll give you the link where you can access that. Well, Reed already gave a nice introduction to me, so I won't go into any more of that. We'll save time for our content. And so let's get right into it. Okay. Fibonacci numbers. Now I know that we have people at all different levels here, so more advanced people, be a little patient, and the beginners, well, here you go. This is where it all comes from. So Fibonacci numbers is really a sequence of numbers. You can see the sequence in the header of the slide. The sequence of numbers are named after a man, Leonardo of Pisa, who was also known as Fibonacci, which means son of Bonnocchio. Back in the days of yore, people were often referred to by their father's name. He introduced the sequence to the West in 1202. However, like a lot of things, the sequence had already been used in India long before that. So they had already been aware of the sequence, and but he introduced it to the West, and so at least in the Western Hemisphere, it's been named after him, which is fine. He made a great contribution, and it's used in many things, way more things than trading. So how are these numbers used in trading? Well, first of all, let's talk about the numbers themselves and how they're derived. Now, you can use the pure Fibonacci numbers in that sequence, which again is across the top of the slide there. And those numbers, some people use them for time intervals for tick charts or even minute charts, moving averages, and various aspects of Gann. And that's all fine. That's one way of doing them. The more common way used by more people is by using ratios, Fibonacci ratios. The primary ratio is 61.8, and that is derived by dividing any number in the sequence that is found one place to the right of it. So, for example, I think I'll bring up my drawing tool here. Let's see, there's my pen. I am a lousy freehand artist, by the way, so excuse me for that. So let's say that we wanted to start with the number 13 here. You can start with any number in the sequence up here. So as I said, you divide any number in the sequence that is found one place to the right of it. So if we start with 13, we would divide that by 21. Here it is. 13 divided by 21 equals 0.619. There's our main Fibonacci ratio of 6.8. Very close. 21 divided by 34, that's taking that number and dividing it by that number there, one place to the right of it. And you divide that and you get 617. Then if we take 34 and we divide it by the number one place to the right of it, which is 55, there we go, 34 divided by 55, 618. So that's how the primary Fibonacci ratio is derived. All right, and now very similarly, then we got a second Fibonacci ratio that's commonly used, and that's 38.2. How is that one derived? Where do we get that number from? Well, very similar, except we divide it by any number in the sequence that is found two places to the right of it instead of one place to the right of it. So again, if we go back to our number 13, if we start with that one, instead of dividing it by 21, we divide it by the number two places to the right of it, which is 34. And we get our 382. Okay, then if we go to the next number, 21, we divide by the two places to the right of it, 21 divided by 15. And there you go, 381. Again, it's not perfectly exact to the exact digit, but it's pretty dang close. And again, then if we want to do the next one, 34 divided by 2 digits to the right of it is 38, and you get 38.2. And you can do that all the way up the sequence forever. Obviously, we don't need to do that, but that's how it's derived. Now, the next ratio is 23.6. How is that found? Well, guess what? Let me clear my screen here. But this is going to get a little too easy for you now. You can probably even guess. So the way that one is found is by dividing any number in the sequence that's found 3 places to the right of it. All right, so again, if we use our starting place as the number 13, now we go 1, 2, 3 places to the right of it. And we divide 13 by 55, and we get our 23.6. And again, I could repeat that, but I don't think it's necessary anymore. Okay, so those are 3 of the ratios that are used. Now, let's talk about some more. 61.8 is the primary Fibonacci ratio. It's often called the golden ratio. It's used in a lot of things in mathematics, architecture. It's found in the structure of even plants and things like that in nature, the nautical circle, everything. 38.2 and 23.6 are what we call secondary Fibonacci ratios, not considered quite as important. Now, we have other numbers, 2 more, and those are 50 and 76.4. 50% is not actually a Fibonacci ratio. Now, there are people I know who argue that 50% does have some significance in Fibonacci, and that's fine. I'll leave them to that. But you have to do a little bit of creative mathematics to find that. But it's not found in the same way as the previous numbers are. So it's simply been observed that it's a very common support resistance level. It's simply halfway between a significant high and a significant low in the market. Gann used 50% a lot, and it is very significant. I put it on all of my charts. And so on Fibonacci drawing tools, you will often find the number 50%, even though it's not technically a Fibonacci ratio. Then the other one is 76.4. Again, this is not really a Fibonacci ratio. It's simply the mirror of the 23.6. In other words, 100 minus 23.6 is 76.4. And that's really where we get it from. Now, some people, more purists, Fibonacci purists, will use 78.6. And that has a more direct relation to Fibonacci because it is the square root of 618. So there is something to be said for that being a Fibonacci number. For me personally, I use the 76.4. I don't find much difference between the two. I don't think it's a big issue. Just from years I've been in the trading world. My dad started teaching me, he was a trader, and he started teaching me when I was 8. So I've been trading for over 40 years, and just over that time of experience, I find that 76.4 tends to be a little smidge more accurate, but again, certainly not a deal breaker. If you want to use 78.6 for the more pure Fibonacci reasons, then God bless you and the horse you rode in on, that's perfectly fine. Now, how are we using these ratios? Okay, now we've determined what they are, what the numbers are, and where they are derived from. But now let's talk about trading. Well, how do we use these things? Okay, what are they actually used for? So it's pretty simple. What we do is we take a impulse move, a major move in the market. So in this case, we're looking from this high all the way down to, oops, my mouse pad just went crazy. All the way down to this low in the market. We're measuring, in this case, from a significant high to a significant low. That's called an impulse move. That's a strong move, in this case, down. Now, here's our Fibonacci ratios. 0 is just 0. There's your 23.6, your 38.2, your 50, 61.8, 76.4, and then 100%. What do those mean? What they mean are, these are called Fibonacci retracement levels. And you'll have a tool, most likely, on your charting platform to draw these lines. And you can often customize what the ratios are. That's why I gave them to you. But quite often they'll be defaulted to these or something very, very close. So for Fibonacci retracement, what you do is you just take your drawing tool. You start here, and you draw it down to the bottom, and then you release the mouse button. And then these different levels will pop up, and it'll draw horizontal lines across your chart. And they are meant to measure, in this case, support and resistance levels for retracements. So the impulse move has been down, of course. So now the retracement would be against the impulse move. So one area where we'd look for the market to find resistance would be here at the 23.6 level. Another one would be here, 38.2. Another would be at the 50% level. Now, first thing I want to point out, because we're going to talk about this in a minute. Now, notice the market did not respond at all. It did not show any resistance at the 23.6 level, did it? No hesitation, no bounce, no nothing. It just went screaming right through it. Then we got to the 38.2. Again, you could say there was maybe a little hesitation because we have a little inside bar there, but still really did not show any resistance. There's no bounce off of it. It just goes straight up to the 50% level. And then that one it does bounce off of, and it comes down to the 23.6 and provides support there. So here's the question. I'm just going to put the question out there right now, and we'll answer it later. But it's very, very important. And that is, how would you determine when you're trading on the hard red edge of the screen? Here we have the advantage of looking at history, obviously. But in real trading, we don't. So in real trading, how do we determine whether the market is likely to hold and bounce back down off of the 23.6 level, or the 38.2 level, or the 50, or even go higher than the 50? How do we know it won't come up to here or up to here? And the first answer that I'll give you is that using Fibonacci retracement tool like this is not enough. It doesn't tell you. All it gives you are potential significant resistance levels that the market may find some blockage of any instance. Which one will the market eventually stop and bounce off of? Fibonacci alone doesn't. We need other things in conjunction with Fibonacci to determine that. And to get to that, I'm going to actually share that with you today. How we put it all together. In other words, we're great at providing these support resistance levels, but it doesn't tell you which one will hold. But they come in here. The market goes down, like I said, it holds the 23 as support. Then we go up. This time we go past 50, go to the 61.8, and it bounces off that one. Then it comes down here, goes to 26, bounces off that. This time goes back up to the 61.8. And yeah, these levels do work. The question is, which one will work this time, meaning when waiting on the hard red edge of the screen. All right, but they're worth because they are significant. Okay, now that's Fibonacci retracement, measuring a retracement against the impulse move. First, let's acknowledge something. This is just one type of market, what I call geometry. And there's other types, Gartley patterns, astrology, squares, all these things can be used. We don't have time to go into all of them today, just because of our time limitation, obviously. So today we're going to just talk about these numbers and their extensions. And so these are the numbers I already gave you: 0, 23.6, 38.2, 50, 61.8, 76.4, and 100. And by the way, you can expand beyond that, and you can go above or below these numbers. So in other words, you could go to 123.6, 138.2, 150. Or you could go the other way, negative 23.6, negative 38.2, negative 50, and so forth. But these are the ratios that we're going to focus on today. Okay, so tool 1 was Fibonacci retracements. Now, tool number 2 is Fibonacci extensions. So let's the Fibonacci retracement tool is what we call a two-point tool. So we started and we found a significant high, and we found a significant low. And what you do is you click on the left mouse button from there, and then you release it here, and your levels pop up on your tool. Now, the Fibonacci extension tool is what we call a three-point tool. So you do that, but then you have to draw to the next significant high. And you're looking for, since we're going down here, you're looking for a lower high. Then, what it does is it, as the name implies, extensions. We're not looking for retracements where the market would then stop, find resistance, and go back in the direction of the trend. Or, I'm sorry. No, that's not what we're doing. What we're looking for now are targets. So in other words, Fibonacci retracements are often used for entries, to find entries back in the direction of the trend after the market has done a trend correction. How deep is that market going to correct before the trend continues? Extensions are used for profit points, and so what you'll notice is, here's the low that we used, and it draws levels below this low, and that's what we're looking for, is some good profit targets. And so what happens? Well, okay, the market, it just goes pretty clearly all the way down to here to 76.4. And that's where it stops. It bounces. Again, how would we know it wouldn't stop at any of the other of these? Well, we'll get into that in a minute. Then it bounces up. Notice we're still using the same ratios there. That's 38.2. Then it goes all the way down to here. Finds support at 100. Now, the 100% ratio on a Fibonacci extension is a very significant one. It even has a name. It's called a measured move. Very famous in trading, a measured move. Always watch for those. So that's a good profit target. Now what happens? Market comes back up to here, 23, goes back down there, 76, bounces back up. So again, you see these levels really do provide excellent support resistance levels, where the market, you can, in this case, take profits. Okay, now here's the next level. Now we're going to get to the next level, just getting a little more sophisticated. This is not advanced stuff yet. This is just now we're going to move from beginning to intermediate level. So this is where we talk about putting both of those tools together. Fibonacci retracements and Fibonacci extensions. We put them both on the same chart. And we look for clusters. In other words, where these horizontal lines get very close together to provide double levels of support and resistance. So, first of all, we draw our Fibonacci retracement. And that goes from there, to this high here. Okay, and then these are, as the market moves against the impulse move, here's our retracement at 23.6. That means it moved from this high back 23.6% of the original move. 50% means, well, it covered half of where it started to where it ended, 50%. Here, 38%. Here, 61%. 76.4%. Okay, that's all it means. Okay, now, so that draws these lines which are marked over here. Then we add our Fibonacci extension on top of that. So again, that's a three-point tool. So we start from here. We go to this high, and then we drop down to this low. And when we do, it brings up these levels. Okay, and they're kind of over here. Some of them are overlapping bars a little bit. But these are your Fibonacci extension levels. And they both can be very significant, but specifically for this technique, what we're looking for is, where do the levels get real close? Well, here, 38.2 retracement and 71.6, 76.4, they get very close right here. These two lines very close together, so it becomes even stronger. You can think of it as a double thick wall, harder to break through. And so sure enough, that becomes a more significant support level. Now, what about up here? We get the 100% extension, which again is our measured move. We always look for that. And 23.6 retracement. So Yes, indeed. Those two lines, they provide the support for the market here. And again, it just kind of goes sideways at that point. Just goes sideways. So that works very, very well in finding a target. Okay, let's move on to some more advanced stuff now. Now we get in some really cool stuff. What we've talked about so far are Fibonacci levels that provide price levels for support resistance. And that's what most people do with Fibonacci. And that's cool. That's fine. That's actually good. Since so many people use it, well, you should too. Because what a lot of people use turns into a self-fulfilling prophecy. However, it's also, I mean, you've probably even heard that it's good to have some sort of a edge in trading. And that's very true. It's very important to have an edge. So right here, you know, I'm going to use my freehand tool again. Yeah, even though I'm not very good at it. I need to be able to mark long periods of time. So now we're going to use a Fibonacci tool that measures not price, but time. And this is very, very important because a lot of people, when you look at their charts, they just have price tools. But very few people have real good timing tools. Now think about that. A chart is a two-dimensional object, meaning there's only two axes, time and price. So time is fully 50% of the information on a chart. So if you don't have some good timing tool, you're missing out on 50% of the information. And since trading is all about establishing a probability scenario to put the odds on your side, how can you do that if you're missing 50% of the info? Well, answer, you can't. You can't. So you better have a great timing tool and know how to use it. Otherwise, you're going to have a real hard time putting the odds on your side in trading. It's just that simple. So here's how we use this one. This is called Fibonacci time extensions. Again, it's actually drawn in a very similar way. We start with a significant low, and we go to a significant high. Oh, my lines are just really stellar, aren't they? I mean, what's happening is my mouse pad's moving around on me. All right. Good thing I'm a trader and not an artist. That's all I can say. Okay, so there's a significant low. And here we go. See how we can get it? Okay, there we go. And there is our significant high. That's where we're drawing the line. You can see it by this line over here, but it's really to that high. All right, I'm going to switch mouse pads. I've got literally a Mickey Mouse pad here. It's really bad. It was given to me as a gift, so I keep it. But so that's our impulse move again. That's our impulse move. Now, everything ahead of these, again, it's an extension, so we're looking for targets ahead of where we've drawn, not behind where we've drawn. So 100%. So now we're looking for, here's our ratios again. One, this time obviously they're above 100%. So 123.6, 138.2, 150, 161.8. Same ratios. But now we're looking for places where the market will turn at a given time, not at a price level. So this one doesn't count because that's where we drew it to. And you notice right from that point the market goes sideways. Now at 123.6, sure enough, we find a significant low there. At 138.2, again, find another significant low. Market goes up from there, goes up from there. At 50, it goes down from there. At 161.8, it goes down from there. Now, so these work very well. The one thing that I will tell you, though, just to be very transparent, I don't hype any of this stuff. I don't need to. As I've already said, none of these tools can be used by themselves in isolation. And so one of the things that you will note here is that these Fibonacci time extensions do not catch every single major turn in the market. So if they don't catch this low, they catch the two highs before and after. They don't catch this high, catch the two lows before and after, but they will catch some of them. Some of them. Now we have another tool that catches all of them, but that's a indicator. But Fibonacci time extensions, they won't catch all of them. Don't expect them to. They don't want you to get, overly excited. But very significant when you do see them. At those points, it's definitely time to say, hey, let me look and let me notice and put it together with everything else. Now here's one of my favorites. This one's really cool. This is called, well, some people call them Fibonacci arcs. Other people call them Fibonacci circles. Both are really true. As you see, the lines kind of curve here like an arc. Okay, that's why they're called arcs. However, if you were to scale out and look at the big picture, I mean, just totally scale it out like an eagle eye, you would see that it's actually drawing a 360-degree circle on your chart. So it is technically a circle. Now, again, we do the exact same technique. We start with the significant high, and we draw our tool, take it down to a significant low. Then it plots these arcs. Now, what's cool about this one is it measures both time and price in one drawing tool. So it's not a vertical line, and it's not a horizontal line. It's an arcing line. So after the market gets down here, now we watch. And you see how the market price just rides this up and then gets exhausted, finds failure, and it marks both a time and a price and a time when that market turns. Again, doesn't catch everyone. There's a significant low. Market comes up, finds the next arc. Sure enough, bam, comes back down. So this is a nice tool in where you've got one tool that measures both time and price in one. And again, not a frequently used tool, so this can provide you with an edge. And I like to call it an invisible edge because not many other traders use it. So they don't even see it on their charts, and you do. That's an invisible edge. Okay, let's finish up here. We've got about 10 minutes, and let's finish up in talking about this issue I raised at the beginning about how to determine which of the support resistance levels, Fibonacci levels, we can expect to hold and which not. So as I said, we can't use Fibonacci in isolation. So in creating a trading method, as I said, trading is all about establishing a probability scenario. To establish a probability scenario, you need a number of variables. And so what I've done is I've created what I call my Top Dog Trading 5 energy method. There's 5 variables. And what I'm doing is I'm actually literally measuring the energy, the buying and selling energy. So I'm not concerned about what people say or what analysts say or even what the news is, because I'm concerned about how people respond to the news, how people respond to gossip or rumors. What are people actually doing? Not what they're saying, but where they put their money where their mouth is. I'm not even interested in bids and asks, frankly, because I've sat next to traders and I've watched them, game bids and asks, put in the bids and the ask, 100 lots on the E-minis, and then pull them before they get filled, all that kind of stuff. Days of the SOS bandits, long gone. I'm only concerned about where people are actually putting their money and committing their money, getting filled. So that's what we're doing. We're measuring the energies of buying and selling. And we do that with 5 different energies. Number 1 is trend. And by the way, when I look at a chart, I'm always looking at a chart in the exact same way. So I'm keeping my mind very orderly. My rules are objective. Well, it's a rule-based method. It's very methodical. And that's how I trade. Very objective, methodical, and rule-based. And again, I keep my mind orderly, so when I look at a chart, I'm always just doing the exact same thing over and over and over. Step 1, there's 5 steps. I look for the energy of trend. And I use a moving average to do that. That helps me determine, first thing, am I looking to buy or sell? Which side of the market am I looking for? Trend trading, again, is not enough for me. Trend trading doesn't, in fact, a lot of trend traders actually have more losses than winners. Even the successful ones. They can make money having more losses than winners because trend trading does provide a great reward to risk ratio. But for me, psychologically, I know I need more wins than losses. So I don't just trend trade. Then I look at the energy of momentum. That's the second energy I measure. And obviously I use a momentum indicator to measure the energy of momentum. Momentum is about the strength of the market. So is it a strong trend or a weak trend? Just because it's moving up doesn't mean it will continue moving up. See, we read on the hard red edge of the screen. I want to know, you want to know, what's going to happen after I get in. And trend is actually by definition a lagging indicator. Even if you're using price patterns, still lagging. Momentum by definition is a leading indicator. And why do I say that? It's just the nature of the energy, really. It's like a locomotive going down a track. It has a lot of momentum. You could put the brakes on that train, and you can predict it's still going to keep going forward for a while. Why? Because that's the energy of momentum. That's what it does. So that's why when we take a trade, we want to know that there's momentum in that market to make it follow through after we take our position. So after I've looked at those two energies, then I look at the third energy, which is cycles. Now, cycles, as I showed you, we have the Fibonacci time extension tool. That shows you one aspect of cycles, but only certain cycles. I've got a cycle indicator that helps you find every cycle high and every cycle low in the market. And that's very, very powerful. So that helps me determine, okay, I want to maybe go long, and okay, it's a strong trend. But now the third question is, when do I want to get into that trend? I don't want to get in at a high and then the market has a false breakout, or it does an ABC complex retrace against me and I got to suffer this loss, this long, drawdown. No, if I'm going long, I want to get in at the lowest low before the market continues up. If I'm going short, I want to get in at the highest high on the correction, whichever Fibonacci retracement level it's going to go to, before the market then resumes its downtrend. And that cycle indicator, along with momentum, helps me determine that with amazing accuracy. Then step 4 is support resistance. Now, that's where Fibonacci comes in. As I've said, Fibonacci levels provide support and resistance, not only in price, but also in time. And that's a blockage of energy. That's a blockage of the first three energies. So that's why we need to know where support resistance levels are, and Fibonacci is one type of form of support resistance, or pivot levels and things like that. But I'm trading these other three energies, and I want to know, well, wait a minute, I don't want to buy into a strong resistance level that's just right above me, or short into a strong support level. I want to buy off a strong support level and short off a strong resistance level. So I need to know where those levels are. But that doesn't come in. See, Fibonacci doesn't even come into my method until step 4. I need to know what the other energies are first. Then, where's the resistance to those energies? And then finally, step 5 is the fractal energy. And that just means I'm looking at the next higher time frame and using multiple time frames to trade, which is a very common practice, but very, very, very important. As I said, this is all about determining a probability scenario. So all I do is at each potential entry point, I ask how many of those 5 energies are aligned. I give this trade a score of 1 to 5. Obviously, the higher the score, higher the probability. And what I'm really doing is I'm saying I need 5 independent witnesses to establish a preponderance of the evidence. In the operative word there is independent. If I were to put 5 trend indicators on a chart, that would not give me 5 independent witnesses. They're all measuring one energy. They're just indicators. Indicators don't make money, otherwise they call them money makers. Indicators do what they say. They, well, indicate. So we're just using the indicators as instruments to measure the underlying energy. And the reason this method works is because the 5 energies are unrelated to each other, uncorrelated to each other. In other words, trend and momentum are completely uncorrelated to each other. All the time you will see trend moving up and momentum moving down. And you say, well, how can that be? Well, it's because they're uncorrelated to each other. And that's true of each one of them. And that is exactly what makes it significant when all 5 energies are bullish or all 5 are bearish. So we don't have too much time, but I use the 50-period simple moving average as my intermediate trend indicator. It just means, okay, market's generally going up. Some people say higher highs and higher lows are the trend. Yeah, not really. The dictionary definition of trend is to extend in a general direction, and the market can make very short-term moves with lower highs and lower lows. 50 MA gives you the extended general direction. Trend is always a long-term move. Energy number 2 is momentum. Now my momentum indicator is down at the bottom, and as you'll see, momentum indeed does often lead price. Here we've got a higher high on price, but a lower high on the momentum indicator. And so it is leading price. And we can actually short, we don't have to wait for lower highs to short. We can actually short higher highs. Why? Because momentum gives us the early indication of strength coming out of the market. Cycles is number 3. Okay, and that's just the rhythm of the market. Market wiggles up and wiggles down, doesn't go straight up or straight down. And that's all great. In fact, of the two, time and price, W.D. Gann actually said timing is more important than price. So he didn't even say they're equally weighted. Again, cycles are great as far as timing your entries and exits, but you can't trade them alone. Why? Because they don't indicate range. And for trading, we want to have big winners and small losers. So we need to have the energy of momentum on our side, not just timing. Here's your support resistance. Now here's where we get to what I was talking about, and then I'm going to have to close it down here. I've just got like 2 minutes left. So I'll just use this one example. If you look at this, we've got our Fibonacci numbers over here. We've measured our impulse move here, and now we're looking for retracements. So let's just take one example here since our time is limited. How would we determine that the market would stop at this level instead of that one, or even any of them below? So what we have to do is we have to combine the 5 energies. We say that, okay, this level is one potential place where the market could find a high and go down. Well, what do we got? We've got that high as resistance, and we have the 50% level. So it's a cluster. It's a cluster, double thick ceiling. Number 2, we've got an engulfing candlestick high pattern. Number 3, the 50 MA is angling down. Even though price is above the 50 MA is angling down, so direction is down. Cycle indicator's turned over. It's turned red, so it's time for this market to go down when it reaches this resistance level. And number 3, look at momentum. When price goes down, momentum is going way below the 0 line here. When price goes up, it barely gets above the 0 line. So there's very little strength when the market goes into this resistance level, and therefore, since it's a double thick wall, it's very easy for the market to bounce off of it, not likely to break down below it. So my trading is very simple. This is basically a simple trade. Trend, first thing we look at, down. Number 2, it's holding support at the 15 EMA. Number 3, we've got a cycle high. Number 4, momentum is down, it's below 0. And then number 5, we look at our next higher time frame. It's the fractal energy, and it's going down. We don't look at trend on the higher time frame, we look at momentum on the higher time frame. And that's a 5 out of 5 trade. So the method's very robust, very adaptable. I use the same 5 method, or this 5 energy method for stocks, commodities, options, currencies, futures. Whether I'm investing, swing trading, or day trading, it's very simple, just pretty much counting to 5. So that's it. Oh, I promised you the free trading course, so here it is. Again, just do this website, topdogtrading.com/free.html. Don't forget to put the .html in or it won't work. And the bonuses are 5 days of video instruction. Each video is about 15 or 20 minutes long. We'll multi-guest quiz at the end of each one. Make sure you got the lessons. On video 4, you'll get my favorite trade setup, the rubber band trade. And then, oh yeah, next Tuesday. Next Tuesday, I'm actually giving, a week from today, I'm giving away a webinar on my free cycle indicator. Well, free cycle indicator. But my gift, because you're part of Investor Inspiration, is that I will be giving away my cycle indicator that day to anybody who attends, absolutely free. And not only will I give you the cycle indicator, but I will also give you a tutorial on how to use it on the same webinar. 1 hour, you get it all, take it, use it, enjoy it. And if you go to this website and you sign up for the video course, then you'll also be notified when that webinar is and how to enroll for it. So, oh my goodness, I went a minute and a half over. I apologize for that. So Reed, everybody over there, thank you very much. Everybody who attended the webinar, thank you so much for coming to the session today. I've enjoyed all the sessions. I hope you have as well.